Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 31st, 2023. It's 10:33 a.m. Eastern Time, so we're 1 hour into the trading day, and wanted to get this one out now. I started to take some screenshots and mark up these charts, and the more I did, I was taking screenshots of Apple and QQQ, which were starting out here, and SPY. And then I realized, you know what? There's so much I want to get out. It's probably going to be more efficient, certainly more efficient for me to convey all my thoughts, everything I'm seeing here in a video. And then maybe I'll take those charts and I'll just add them under this post for those of you that don't have time to watch the videos. That's why I'm explaining why, I doing the video versus the screenshots, which I know many prefer because they don't have time. So we are, let me just keep it the fairly simple version. We're in that no-go zone. This is where I said it's bullish if we break out. In my opinion, it does not make, it's not objective at all to add any short exposure here. If anything's time to, if you didn't already stop out because we took out the trend line, time to start setting some stops and scaling out depending on where you think things are going. I'm going to show you a couple things here that might lead this to be a false breakdown. But let me be very clear on that. If this breakout fails, the breakout above the downtrend line and these other levels I'm about to give you, then that could provide an objective time to close any longs you might have taken here recently, today, or down here when we had the divergence and hit support and all that, or flip back into shorts if you get out of shorts, because to try to anticipate a breakout that's going to fail, that's pretty tough. So as I always say repeatedly, resistance is resistance until unless taken out, and it has been taken out, and then that becomes support. So we closed right on it. Remember in the beginning of the day yesterday I said we may get a non-event day, and that's exactly what happened. We closed right on there, so there was no update needed. We didn't break out. Today we're above there. But let me show you a few things. So this is that same, what it does, plain and simply, it increases the odds. It's just like real-time betting. If you go to the horses, you bet the horses at the track. The odds change, are constantly changing up until they close betting right before the race starts. And so right now the odds shot up pretty significantly today because QQQ is broken out, and that the odds I'm talking about going to that marginal new and still divergent high scenario like I talked about. That's what it color coded these lines. I just made it a little different. So we're still coming off a divergent high. We are still, if you turn off all the little lines and drawings and all that, we still have a near-term downtrend that's defined as a security making 1, 2, 3 lower highs and lower lows. And so I'm going to give you a few things here. And like I always say, react. Be, as an active trader, be ready to react to anything that changes in the technicals. But as of now, like I said, that's a breakout, and it's going to increase the odds we go up. Now, by the time this day, or by the time the day's over, or let's say it's next week, we fall back down below there, then that's going to increase the odds that we can go on down. But the big levels remain. The low from a couple Fridays ago, Friday before last, right there. That's the red line. I've marked it up, 354.70. Nothing's changed on my views there. And most importantly, the downtrend line. That's where, again, that was one of the cases for this recent bounce. The QQQ fell down, and now we clearly have that trend line validated with 2 additional tags. So that's why these levels are color-coded red. So there's your, and we've gotten high enough now away from 354.70 that would be a very objective short. I'll tell you. Here's the levels. And to get out of longs, right there. If this breakout fails, a break of that's a more aggressive entry there than this one, I think, because we could just dip back down. And then that one. Those 3 levels, to me, would be lights out. We're coming up on the good old month of September, historically the worst month in the market, and there's plenty of fundamental reasons why we could see an ugly September. But right now the algos, and this is the way this market works, the machines get in, they start buying, and they accelerate or accentuate any trend that's currently in play. And then when the algos flip to from buy to sell, then we go down. Okay, so let's not overanalyze it. Breakout, bullish, no more shorts for me. We'll be concerned to start covering those shorts soon. I'm giving it just a little bit more rope, and here's why. So you have SPY. SPY is currently backtesting this trend line right here. This is the trend line off the March lows. We've got a couple reactions along the way. Danced on it a few days there, broke down, and we're currently backtesting. We were backtesting yesterday, and we're backtesting again today. So that is also, like I like to say, resistance is resistance until unless taken out. So if we get a solid move up through there, especially a daily close, same thing with QQQ, then that's bullish. Right now, we're ever so slightly above it, so we're going to chalk that up to the bullish camp. But again, if we reverse and we stay below it, what you want to see when you backtest, I always say this, a backtest is an objective short entry when you break down and you backtest, especially a hard resistance level like this from below. But when you're backtesting a trend line, the problem is they're dynamic. Prices come in at higher and higher levels every day, and so shorting a backtest can just continue to put you underwater. So you really I like to see that big rejection, a big red candle, a reversal off there, and then that helps to validate the fact you got rejected. So remember, we're still coming off a nice big bearish engulfing candle that marked a top in the S&P 500 right there, and we're still well below that bearish engulfing candle. So there's still the potential that that's a top there. So a lot of mixed bag. As of now, again, as I'm talking here, bullish right now. Nothing that I'm seeing is not bullish. I'm just showing you things that could change that. And then last but not least is Apple, the king of the S&P, king of the Nasdaq 100, and it has now clearly entered that gap. Okay, remember we had these things move. T2 was there. I had it set just below the gap right here, the bottom of the gap, and so that increases the odds for a run at the top of the gap. So all that. What I just showed you on QQQ, not so much on SPY, but on QQQ, bullish. And QQQ is, the more important of the two, if you will, because it's just a higher concentration of the market leaders of the Magnificent Seven, they call them: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta. All right. So a lot of bullish evidence. Again, no objective case to short, but why why am I talking about a potential failure at this point instead of just an all-in long moment? I'll tell you why here. This 5-minute chart, to me, I covered all, time to time I covered, active trading. I seem to get not a lot of feedback on these short-term trading ops that are only good for, usually good for 1-2%, sometimes more. I view the charts and trading this way. Every turn in the market, even the bigger turns, the major, every bear market bottom, every bull market top, it all started with a turn and some bearish technicals indicating that turn was coming on the shortest of time frames. So 1 minute out, then 5 minute, 15 minute, 60-minute charts. 60 minutes, my go-to swing trading time frame. 1 to 15 minutes, maybe 1 to 10 minute charts are my go-to active trading. That's day trading or trades that may last more than just a few hours, might be overnight, 1 or 2 days. And so this is that 5-minute chart of QQQ. So what you can see here, you just look for these divergent lows, and again, they're not all big moves, but they're all just about every one of them has been followed by they're all 1%. That's a 1% move. I'm just going to draw the arrows real quick. Divergent low, you get a 1% pop, and the market turns. Divergent low, that's better than 1%. That's probably 2+%. This one's probably 2% or so. That was not a divergent low. It was just a low. And you had a trend line break, and then you put in a divergent high here. And so this is where the near-term trend inflected. Remember, I've been talking about the very near term. Okay, so I started out in the video showing you on the 60-minute time frame, we're still in a downtrend off the highs. That's more of the, we'll frame that as the intermediate, and this is a very short-term time frame. So back here on the 18th, there's your dates down there. We bottomed on that gap down and then went up. But again, you're seeing these 1+% pullbacks. This one was almost 4%. That was also a divergent low. Duplicate that, just put it there. And so it's not uncanny. I've been doing this for many years. It's just how the markets work, and it's not. These are not immutable forces, meaning that once you have a divergent high or divergent low, that you must turn. Sometimes they're burned through. These are, like I use the analogy of the the hash mark or the first down markers on football. You get a first down, you're going to move the lines, and so these lines can be moved, and sometimes you just keep going up. And then what happens if you go up past your previous high, you no longer have divergence. However, this is the kind of divergence I like. What I mean by that, I like to see these clean separations, between the peaks. Sometimes you get, 1, 2, 3 peaks. There was divergence right there, and it did. That was it, the first divergence, and it did lead to pullback. But this is about, you can see the span of what you get there. Usually you get that big or bigger, and you get a pullback. So this indicates to me, this 5-minute chart, you're probably going to have a pullback now in the Nasdaq. At minimum, it's going to take you to this trend line right here. That's going to be if it starts right away here soon, it's going to be about a 0.75% pullback. And then if that breaks, that's a much more significant trend line. It could have a more downside potential in QQQ. That's what we look like on the 15-minute chart. Here's a reaction. Here's the top of the gap right there. I'm sorry, the bottom of the gap. So let me put that, and I'm talking about this gap right here. So I just moved that line there. Traders love trading these gaps. They act as resistance when checked from above. Once you enter the gap, if you're solidly in there, sometimes you'll punch a little bit above it or reverse a little shy. But there's some resistance there as well. And then that divergence shows through on the 15-minute chart as well. Okay, all right, had to pause it there, take a phone call, important call. Let me just update where I believe I was here talking about. We have this divergence out here to the 15-minute chart as well, and big old gap right there. So we're at gap resistance, and last day of August, heading into September, and the near-term downtrend is still bearish. So therefore, when we have SPY at resistance, I think there's a good chance that we're going to see a reversal here. And what we need to do, we have to get back down below that trend line. Let's just pull it right here. That's probably the best fit on this. Again, this is a 15-minute chart. There's your reactions. We hit it yesterday, parked on it, and then this was the breakout today. So, this market has been full of trickery for decades now, really, for throughout history, going back to the old school market makers back in the day, then algorithmic trading programs that sniff out levels, firms with enough capital induce breakouts and then see a failure. But let me be clear again, until and unless we fail, it's a breakout. It's bullish. If you get a failure, the levels to watch again would be a move back down through the downtrend line, solid move there, and then let's not forget this was also pretty significant resistance there, about 372.85 give or take, and so those are the levels. And all right, so let's just see where we go. If we do hold this level and we can build on these gains into tomorrow, hold the breakout, get SPY. That's the things you want to see on the bull case to start adding to longs. I mean, you could certainly have added today on the breakout, and then just the nice thing about taking a breakout is that you take the breakout, you go long, and then you have stops just a little bit below the breakout point in case it fails. And it's an easy high RR trade. If we're going to go on to that marginal new high scenario, again, I'm just guesstimating based on my read on the charts, is going to be probably about a 4 to 8, let's say 4 to 8% would be my guess. Probably in that 4, 5, 6% range, marginal new high. And why do I say? Well, for many reasons. Macro, fundamentals, technicals, long-term, everything else that I've covered for months now. But also the fact that it needs to be that to keep these divergences intact, to keep that scenario very well and alive, the divergences that we have here on the all-important daily time frame. So because anything much more than that, then you're just going to take those out, and then there's something different going on. All right, so that's about it. We know what to watch. There's Apple again, just slightly in the gap. Not by a wide margin, but in the gap. So again, a failure. If it falls back down below it, then that's a failed attempt to enter and backfill the gap. And so, just update that because that's also a trade. Yesterday when we hit that T2 level there, I said, you still have a potential if you're going to enter the gap. There's a potential for a backfill. That's where the two places that usually the sellers are going to step in. And although they parked it there yesterday, that's in a sense of reaction. We traded on that level for a little bit. That would be your next resistance level. And then anything much above that, there's really not much resistance. Then you have your previous highs, and then you're probably going to break out and run up there. So as of now, I'll still maintain these additional price targets for a long-term trade. But this is where really above that top of the gap is where if you shorted Apple, got back into a short, or you're currently short, that's where you might want to scale out. And if you're bullish and long and you took it here, it was a trade idea here, maybe you're just riding up the momentum. Maybe you raised stops to let it run yesterday, and no problem. Just keep doing that. Raise stops. Know that the levels, if you break out above there, that's going to be bullish. But Apple, I imagine, like QQQ, if I look at the 5-minute chart, which I just did here, you got the same thing there. You can see last time I marked a divergent low was here. You can see them there. It was a beautiful little. These are the turns. These are the inflection points. And on Apple, let's see if we've got a decent. I don't want to force it. Not crazy about that trend line. This is a more significant trend line I see right here. One that I believe we'll come back to. And that would be, let's just say it plays out soon. It would entail these 5-minute divergences playing out, and that's going to be a drop of, again, minimum target 1.2. But if it happens, it's going to have bigger repercussions, because it will mean if we get a 1.2% drop and it happens soon, that's going to take us back down below the bottom of the gap, or right around to it, to be honest with you. If you're looking at it, let me measure here. 1.2, yeah, right around, give or take. So we need to do a little bit more than that. Okay, just one more thing, so keep this video relatively brief, get it out to you, is the euro. So if you recall yesterday, I mentioned we took out this downtrend line, but we ran into pretty darn good resistance there at that 109.375 level. Pretty impulsive rejection off there. Remember, I've showed you time and time again, and then maybe I'll do it now, if you, show you the strong relationship between the euro and the stock market. So the stock market hasn't gotten this memo. Maybe it's just the market believing the euro is going to go on to back test. But if we continue to move lower, we already moved down below that trend line there. It's kind of this 60 minutes getting sloppy. I have a lot of resistance levels, but so far that's the one that capped this rally. And bottom line is the euro's down today by about 0.6%, which is a pretty decent move for the euro. Again, if it can rally on up here, power on through those highs, this will support the case for new highs in the stock market, that marginal new high. To see the euro pop here and rally up, I have a trend line that would be your next resistance level, an uptrend line. This is a daily chart here. And then I have a resistance here. And you also have this previous high I should put, and I will right now, level right here. You have 3 candlesticks there at that high. So that would be a target zone here. That would be net bullish for the stock market. Why would that be? Well, if you took FXE, which is the Euro ETF, or ETN, technically speaking, and compare it to the stock market, and we'll just use QQQ in this example, and we'll turn off all the other lines. You can see that, which I've covered many times, that unmistakable correlation, especially the larger term trends. Day to day, you get a brief disconnect. Sometimes they can last a few days, but there's almost always a mean reversion. In this case, the euro started going down. You're looking at the green and red candlesticks, and the stock market decided to ignore that. Didn't get the memo, but guess what? When it finally said, well, we're ignoring a pretty strong positive correlation, because I went to FXE only because that shows you the trades. It's an ETN, so just like SPY, which I compared it to, or QQQ here. I mean, that's showing you the 9:30 to 4 p.m. trades. On EUR USD, it trades around the clock, so the charts aren't going to match. And that's it. So it was a hard down, and that's playing the market playing a game of catch up to the euro. So ignore those divergences at your own peril. Again, this is just a 1 day here, but overall you can see we've had the euro moving down, and the market got that memo. But lately it said, let's go this way. And the euro started to agree, but right now it's saying no. So watch this. I've been talking about watch the euro, watch treasury bonds. Those are, I can't think of anything else. I wouldn't even pay much attention to GDP and employment data and all this. Right now, I think the single most important thing is our long-term rates, mainly the 10-year treasury bond yield, and also what the euro is doing and the dollar. They're going to have one of the biggest impacts on the stock market. So there it is, guys. Like I said, just to kind of bring it home, if you are an active trader or risk adverse, you could certainly cover if you are short. That is, if you shorted yesterday at that level, which I believe was objective, and still do. I wouldn't short it now. I'd short a failure. And personally, I think I'm going to give it a little more room and see if those 5-minute divergences play out like they so often do. And then if that happens, that can set the stage for a much bigger drop. Because as I often say, fewer things are more bearish than a failed breakout that all eyes see and shorts cover. They get squeezed out and cover their stops are hit, and then longs pile in, and then both of those parties realize they were wrong. That means the longs sell out because their stops are then hit, and the shorts pile back in, and you can see a pretty swift drop. That hasn't happened yet. Okay, so as of now, in real-time odds, the odds favor more upside here. But should those 5-minute divergences play out, and should this breakout fail, the odds are going to change pretty quickly, in my opinion. And you have the levels in which they change. So it's not an all or none, 100% chance. No, it's incremental. There's increases the odds over 50% that we're going to go, the longer term bearish scenario play out if the breakout fails. If we take out 372.84, it's going to increase the odds even further. And then if we take out the primary uptrend line, the red uptrend line, even further, and then lights out, in my opinion, under 354.70. Okay. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.